When it comes to buying a home, one of the biggest and most important questions is how much house can I actually afford? It's easy to get swept up in the excitement of house hunting and lose sight of your budget, especially when lenders and online calculators tell you that you're pre-approved for a huge loan. But here's the reality. Just because a bank says you can afford a certain amount doesn't mean that you should. Stretching your budget to its limits can leave you house poor, where your dream home becomes a financial burden. In this guide, we're going to dive into how to figure out how much home you can actually afford based on your salary. We'll discuss tried and true financial formulas, practical examples, and the hidden costs that often catch buyers off guard. Whether you're buying your first home or upgrading to a bigger place, this breakdown will help you make a smart, informed decision. So let's get started. Hey, what's up you guys, and welcome back to my channel. I'm Dr. Furrukh, and I'm here to help you achieve financial independence, build wealth, and live life on your terms. If you're ready to take control of your finances and your future, you're in the right place. I'm a first-generation immigrant who started with literally nothing. My journey began in high school with a simple t-shirt business that I grew in high school and later sold in college. By the time I turned 30, I had done over $10 million in gross sales and launched multiple successful businesses in retail, fitness, e-commerce, and even consulting. Today, I live life on my own terms, and I'm excited to teach you how to do it too. On this channel, I share you the tools, the strategies, and the mindset it takes that help me build success from the ground up. Whether it's real estate, growing a business, or tackling financial challenges, you'll find actionable steps, real-world insights, and the motivation to create your dream life. If I can do it, so can you. So hit that subscribe button and join me as we work toward financial freedom, step by step. Let's build your legacy together, and let's jump back into today's topic. The 28-36 rule, the industry standard. The 28-36 rule is one of the most widely used benchmarks for determining how much house you can afford. It's a simple guideline that helps you calculate your budget without overextending yourself. The first part of the rule states that your monthly housing costs, including your mortgage payments, your property taxes, and homeowner's insurance, should not exceed 28% of your gross monthly income. This ensures that your housing expenses are manageable and leave room for other essentials. The second part of the rule states that your total debt, including your housing costs, your credit card payments, your car loans, and your student loans, should not exceed 36% of your gross monthly income. This is your debt to income ratio, or your DTI, which lenders use to evaluate your ability to repay loans. So example, if you earn $75,000 per year, your gross monthly income is about $6,250. According to the 28-36 rule, your maximum monthly housing cost should be $1,750, 28% of $6,250. Your total monthly debt payments, including housing, should not exceed $2,250, 36% of the $6,250. This means that if you already have $500 in monthly student loan payments and $250 in your car payments, your maximum housing budget would drop to $1,500 per month. The 28-36 rule is like a financial diet. It keeps your spending in check so you don't overindulge and regret it later. Why it matters. The 28-36 rule is a solid starting point for determining your budget because it helps you maintain a healthy financial balance. It ensures that you're not overspending. It helps that you're not spending so much on housing that you neglect other financial priorities like savings and retirement. Number two is income levels and home affordability. Let's break this down further by looking at how much home you can afford based on different income levels. Using the 28-36 rule, we can estimate that the maximum home price for a variety of salaries. So let's start with $50,000 annually. That means monthly gross income of $4,167. Your maximum housing cost should be $1,167 per month. The estimated home price around $175,000, assuming you have a 20% down payment and a 6.5% interest rate. Or we have the $75,000 annual salary. Your monthly gross income would be $6,250. Max housing cost would be $1,750 per month. So the estimated home price around $260,000. With an $100,000 annual salary, your monthly gross about $8,333. Your max housing cost should theoretically be $2,333 per year. The estimated home price maybe around $350,000. At $150,000 annual salary, your monthly gross income about $12,500. Your max housing cost should be $3,500 per month. Estimated home price around $525,000. These numbers assume you have minimal debt and a 20% down payment. If you have significant debt or a smaller down payment, payment, your budget will be lower. At $50,000, you're budgeting for a starter home. At $150,000, you're asking the realtor, does this come with a pool? Why does this even matter? Breaking down affordability by income helps you set realistic expectations. It shows you what's possible within your salary range and highlights how factors like debt and down payments truly impact your buying power. Before we dive deeper into how to calculate your home affordability, let me ask you something. Are you getting value from this video? If so, please hit that like button and subscribe to the channel. We're breaking down important financial topics like this every single week, and I'd hate for you to miss out on more topics and more tips to help you live better, live smarter. Plus, it helps the channel grow so we can keep creating content that matters to you. Now let's go back to figuring out how much house you can really afford. Number 3 is the importance of that debt to income ratio. Your debt to income ratio is one of the most important factors lenders consider when deciding how much you can borrow. It's the percentage of your monthly income that goes towards paying off debt, including your mortgage. Lenders typically want to see a DTI of 36% or lower. However, some may approve loans with DTIs as high as 43%, especially for borrowers with strong credit. But just because a lender is willing to stretch your limits doesn't mean that you should. And why does this even matter? A low DTI gives you more financial breathing room. For example, if you earn $75,000 a year and already spend $750 on monthly debt payments, your maximum housing budget drops to $1,500 per month. This ensures that you can comfortably afford your mortgage while still paying off all the other obligations. A high DTI is like trying to fit one more suitcase in an already full car. You're asking for trouble. So how do you improve your DTI? Pay down high interest debts like credit cards before buying a home. Avoid taking on new loans such as car loans or personal loans in the months leading up to your home purchase. Increase your income through side hustles or overtime to lower your DTI percentage. Number 4 is down payments, and why do they truly matter? Your down payment is a critical factor in determining how much house you can afford. The more you put down up front, the less you need to borrow and the lower your monthly payments will be. Here's some down payment scenarios. 20% down payments, the gold standard, avoids private mortgage insurance or PMI and reduces your loan amount significantly. 10% down payment requires PMI but is more attainable for many borrowers. Then there's 3 to 5% down payment, common with FHA or conventional loans, but comes with higher monthly payments and PMI costs. For example, a $300,000 home, 20% down, $60,000 down, $240,000 mortgage, 10% down, $30,000 down, $270,000 mortgage, PMI 5% down, $15,000 down, $285,000 mortgage plus PMI. While lower down payments can get you into a home sooner, they increase your monthly costs and can leave you with less equity. A big down payment is like eating your vegetables. It's tough now, but it's good for you in the long run. The size of your down payment affects your monthly budget and overall affordability. Saving for a larger down payment can significantly reduce your financial stress. Number 5 is the hidden cost of home ownership. Many first-time homebuyers focus solely on the mortgage payment, but home ownership comes with additional costs that can add up very quickly. Common hidden costs like property taxes. These vary widely by location. For a $300,000 home, annual taxes could range from $2,000 to $6,000 for the year. Homeowners insurance protects your home from disasters and typically costs between maybe $1,000 to $1,500 per year. HOA fees. If your home is in a community with homeowners association, expect monthly fees ranging from $100 to $500 or more. Then there's maintenance and repairs. Budget at least 1% of your home's value annually for true upkeep. For a $300,000 home, that's $3,000 per year. Utilities. Larger homes mean higher bills typically for heating, cooling, and water. Owning a home is like owning a pet. It's great, but there's always some unexpected costs. Why it truly matters. Factoring in these hidden costs ensures you're fully prepared for home ownership and avoids financial surprises down the road. Just always plan. Buying a home is one of the biggest financial decisions you'll ever make, so it's crucial to get it right. By using tools like the 28-36 rule, accounting for hidden costs, and sticking to a realistic budget, you can avoid the pitfalls of being house poor and enjoy your home stress-free. What's your biggest takeaway from this breakdown? Let me know in the comments below, and if you haven't already, don't forget to like and subscribe for more financial tips and insights to help you make smarter money decisions. Remember, it's not about buying the biggest house. Let's enjoy financial freedom long term.